Hello and welcome to this week's update, looking at some technical questions that we've had. And the one that we're looking at this week was a question that was interested in pullbacks when you're trying to enter a trade and whether you can get a better entry point. Touched on retracements as well. Well, we did look at Fibonacci retracements last week, so what I'm going to concentrate on this is two specific techniques that I regard as much better as Fibonacci. One of the problems with Fibonacci is that which level do we use? 0.382, 0.5, 0.618. Also, as you probably a lot of traders will know, is sometimes you get the identification of a trade and then the market just immediately moves and there is no pullback. And so the technique I'm going to show you today enables you quite often to still get involved because it's telling you that there is a dynamic trend. And what those two studies are what called peak or swing points or fractals, and a very simple moving average technique. So first thing is what we're going to look at is peak. Peak is an exit trend confirmation or breakout tool that is dictated by price swings rather than the momentum itself. This means it's more dynamic to price action. The default settings are the ones that I use for building trend lines, and they can be adjusted depending on the concept of risk. And what we're looking for is a 3 or 5 bar pattern, and if the middle bar is the lowest or the highest point, it simply references that level until the next time it happens. And so if we have what's called swing points or fractals that move higher, then that pattern's going to move with it. This is what a peak looks like. I'm using the 5 bar example, and all it is that the middle bar is the highest or the lowest point. I have absolutely no interest in what the relationship of the bars either side of that middle point happen to be. So now we're looking at the cable chart, or the pound against the dollar. It's on a 30-minute basis, and it's just showing the chart action through the beginning of the week. And what we have on here is the peak study, and I'm using the 3 bar pattern. And what is happening here is when the lowest bar of 3 is the middle point, it holds it, or is the lowest point, it holds it until the next time it happens, and so on and so forth. And if it's going through the high point, it tracks back the other way. So it's just measuring those fractal points. The other study that I put on there, which is the black line, is a 3-period simple moving average, and it's offset 1 bar into the future. And the reason for doing that is that it enables me to have a fixed reference point for the current bar. So I'm not waiting for the time frame or the chart to finish. I'm not watching the moving average move up and down causing me psychological problems. It always has that reference point. And on here what I have is 3 horizontal lines, and what they are the way that I generate supports and resistances, which I'm not going to go through how I do that today. But these are the levels that are put in the technical reports that I write every day. And if I just show you this, it's showing on the chart here, it's showing you what the price action was. I write a little bit about what the key points are, and I might give some buy or sell recommendations, and in this instance I was a seller at 151.11. I'm going to start on the left hand side of the chart here, and originally what I had was this support point of 149.76. And if we look at the chart on this bar here, it just went straight through that level and completely ignored it. And this is very important if you're understanding supports and resistances, whatever the methods you wish to use. I normally like to see confirmation, so I'm not just going to blindly buy at 149.76. Ideally what I want to see is that the level is respected, and then the market makes some sort of move back the other way, and then I want to try and get involved once I know that that low looks like, or that level is looking like it's going to work. In terms of whether a level is wrong or not, I say to anyone who reads the reports that as far as I'm concerned, whatever methods they're using, if it's gone 50 points beyond the level, that is the point where the trade is definitely not works. So it gives people an idea of what the disaster stop may be. On this piece of data here, price then ambled around, rallied back through the level, came back down, and sort of really didn't do very much until the afternoon when America opened. And at this point I got a signal to say yes, the level is held, and now I can try and get involved. And what it is this candle here, where price closes above what I call the high peak level. So in other words, it's broken a fractal or a swing point high and closed above it. So if I'm looking for an opportunity to get long, where I haven't had a pullback, any breakout above a peak level if it was a buy, or below a peak level if it was a sell, is a point where I can get involved. If we go a little bit here, it happened early on, and so that could have been a trigger point as well. And I would have now, what I've done is, if price just simply goes below the absolute low that has been created before, that would be my stop out point. I'd just give it a couple of ticks either side. Then what happens is price rallies quite strongly and it comes up to my area of resistance, which was 150.75 to 51. Well, when we got to 150.75, price just stalled a little bit, but this is where the use of the moving average becomes involved. The basic fact of using a 3-period simple moving average 1 bar forward is the fact that this is probably the tightest money management that you can use in regards to using momentum. The fact of the matter is we only really need a period of, quite a short period of consolidation or a little bit of a pullback, and that 3-period moving average is simply going to change direction. There's two things I can do. If it does change direction, I could get out of the position, or I could wait for price to close below the average, and that would confirm it. The other thing I can do is use the peak study that was the opposite side of the breakout and use this as a trailing stop. And when price closes below that peak level, it tells me that the trend for now is over from a swing pattern or fractal basis, and really I should be getting out. So it's done two things there. It's given me an entry, it's let me track the trend, and then it's told me when the trend is definitely over. When we got into this area of 150.75, the moving average did close down, but at no point have we broken the low peak, so it's not really given me permission to get short yet. The price then comes up to the top of my level at 151.11 and then does close below the peak. So I could, if I was very aggressive, get involved there, but I'm still in this zone, and so if I want to be a little bit more careful, I can wait for a candle to break and close below the low peak, which is what happens here, and then I can say, with the moving average already turning down, I have permission definitely to get short. So I have two choices. I could have got in around this area here, or I could have waited for here. The market then comes back down to what was the previous support, and this time it works much better than previously, and we have two further things that we've talked about in previous weeks that happens, in that we have dojis. So there's two dojis, and it's held my support point. For me, you know that dojis are the only real candlestick pattern I believe in, and if I'm being very, very aggressive, I could say, fine, I'm going to get involved down here, and I can put a stop below the low, just below 49.76. Alternatively, I could wait for the moving average to change direction, which it does here. If I'm very aggressive, I could add volume here because I could still control risk below the absolute low, and then we break out above the peak. So if I wanted to, I could have waited for that, or I could have added to the position yet again. We then come back to this 50.75 point, and we stall. The moving average then turns down, and on this bar here, we close back below the low peak value. So I could have stopped and reversed if I wished, if I'm being very aggressive. The other thing that's interesting me here is that red candle is showing an expansion of range. That is actually the biggest range between the open and the close pretty much of the entire trading day. And so that's telling me that something out of the ordinary is happening, and I can get involved once more. The market then has a fairly slow trend. It is happening after America is closed, and price eventually comes back to my support point once more. So in conclusion, retracements or Fibonacci retracements are a little bit random, and you can miss moves that become very dynamic once you've entered. You can use peak to qualify the breakout. You can use peak to then track that trend. You can use the change of the 3-period moving average 1 bar forward to say that the trend is being confirmed. And again, if price closes back beyond that average or turns down in direction, you can use that as an exit as well.